Welcome to The Deep Dive. Today, we're really getting into the weeds, unpacking something that affects pretty much everyone, the world of payments. It feels like everything's changing so fast, doesn't it?
It really does.
Paying with your phone, sending money instantly, getting paid quicker, it all feels fundamentally different than even a few years ago.
Absolutely. The whole foundation is shifting.
And what's really driving this massive change, well, according to the sources we're looking at today, it's us. It's the customer. Our expectations are basically rewriting the rules for banks and finance companies.
That's spot on. Our sources are really clear about this. What customers now demand, speed, security, convenience, knowing what's happening, that's become the absolute baseline. It's table stakes.
Yeah.
And this, well, it puts traditional banks in a really tough spot. They're suddenly facing fierce competition from FinTechs and these digital-first players who, frankly, were built for this new world.
Right. They didn't have the baggage of the old systems. So the research and articles we're digging into today really focus on this critical moment, this crossroads. They lay out the challenge, and then they zoom in on what's being presented as a key part of the answer: payment hubs.
Exactly. So our goal here, our mission for this deep dive, is to really unpack this material. We want to understand what payment hubs actually are, sure, but more importantly, why they've become so critical, like right now.
Yeah, what makes them tick?
We'll look at the sometimes surprising facts and figures the sources reveal. There's some really interesting data on how customer behavior is shifting, the kind of operational friction banks are dealing with.
And even the money involved?
Oh, yeah. Significant financial losses that businesses are apparently facing because of outdated payment systems. It's quite eye-opening.
Okay, let's get into it then. The sources jump right into the heart of the problem, which, like you said, starts with the customer and what they now expect.
It has to start there, according to this material. Fast, secure, completely frictionless payments, they're not just a nice-to-have anymore.
Yeah.
They're not a bonus feature on some fancy app.
No.
The sources state pretty emphatically that these things are now the reason customers choose where to bank, who to trust with their money, how they interact financially. It's fundamental.
And you can feel that yourself, right? Think about when you buy something online or maybe Venmo a friend or split a restaurant bill using an app. You just expect it to work.
Yeah.
Instantly.
Right.
You want that little buzz confirmation right away. You want to see the money move, no weird delays, no confusing steps.
Exactly.
And the argument in these sources is that we now take that same expectation forged and, using DoorDash or Amazon, and we apply it directly to our main bank.
Yes.
So if your traditional bank's process for, sending a wire transfer or maybe setting up a new bill payment feels slow or clunky compared to these other apps, well, that bank looks instantly out of date. They're at a disadvantage.
Precisely. And when the sources talk about frictionless, they mean the whole journey. From the moment you decide to send money to the moment it's confirmed received.
Seamless.
Totally seamless. You hit send, you get immediate feedback, you know where things stand, any costs are clear up front. That builds trust. It builds convenience. And the sources really hammer this point. Any friction, a confusing online form, having to make a phone call for verification, unclear fees popping up, a delay in seeing the transaction post, anything like that, can chip away at the customer's trust.
Yeah.
And it affects how they see the whole bank, not just that one transaction.
And this is where, according to the sources, the problem really hits home for the traditional banks. Because while our expectations have shot up into the digital stratosphere, a lot of them are still running on technology built for a totally different world.
Yeah, the legacy systems issue. It's central to the problem described in the sources.
Okay, so why are these legacy systems such a problem? What makes them create friction?
Well, the sources explain it. Comes down to how they were built, often decades ago, right? Way before the internet as we know it, certainly before smartphones, and definitely before anyone thought about a customer needing a smooth experience across, say, their laptop and their phone, and maybe even talking to someone in the branch. They were built in silos.
Silos. That sounds isolated. How does that translate into a headache for the customer?
Think about it like this. Maybe back in the 80s or 90s, the bank built one system, completely separate, just to handle ACH payments, direct deposits, bill pay, that kind of thing.
Okay.
Then maybe they built another totally different system, maybe on a mainframe, for high-value wire transfers that businesses use.
Different tech, different team, maybe?
Often, yeah. Different tech, different databases, maybe even different programming languages.
Yeah.
Then you've got the whole infrastructure for processing debit cards, maybe another system for handling international payments. Getting these separate systems designed in different eras for different jobs, speaking different languages, to work together smoothly.
Sounds like a nightmare.
It's incredibly difficult and expensive. They weren't designed to talk to each other, to share customer data seamlessly, or to handle a single payment journey that might need to touch several of these old systems.
And that fragmentation, that lack of communication between the bank's own internal systems, that's what creates the friction we feel as customers.
Exactly. It causes delays because data often has to be rekeyed or manually reconciled between these systems. It's a recipe for errors.
Yeah, I can see that.
And maybe most frustratingly for you as a customer, it leads to really inconsistent experiences. Making a payment on the mobile app might feel okay, but maybe initiating a wire transfer online still triggers a required callback because the systems behind them aren't properly connected.
Ah, okay, so the channel you use or the type of payment dictates how clunky the experience is because of these underlying silos.
Precisely. And the source material gives us a pretty stark statistic on this, focusing on the business side. It says that 57%, over half of organizations, run into friction with their payment processing at least once a week.
Once a week? Wow. Just let that sink in. More than half of businesses are hitting snags, delays, errors, confusion, trying to move money every single week. That's huge.
It really is. And think about what that means for a business. Weekly payment friction isn't just annoying. It's lost time for employees chasing things down. It's potentially disrupted cash flow, maybe late fees on their end, or strained relationships with their own suppliers or customers.
And it hits the bottom line.
Directly. It impacts efficiency. It impacts costs. It really highlights this gap between the smooth digital world we expect everywhere else and the often still clunky reality of many traditional banking processes, especially for businesses relying on that infrastructure.
Yeah. Imagine running your company knowing that pretty much every week you're going to waste time just trying to pay someone or get paid. It paints a really clear and honestly quite concerning picture. And while the banks are wrestling with this internal spaghetti monster, as the sources point out, the competition isn't exactly waiting around.
Not at all. The sources are explicit. FinTechs, the digital native banks, they didn't inherit this mess. They built their systems clean, often from the ground up, in the digital era. Many started with a unified platform approach from day one.
So they set a different standard.
They fundamentally reset expectations. They offer these clean, intuitive apps, real-time updates on everything, fee structures that are often simpler and definitely more transparent.
And the result is pretty predictable, isn't it? If traditional banks can't easily modernize their core plumbing, they struggle to offer that same level of service.
Exactly.
And if your bank's app feels slow or less informative or just harder to use than, say, PayPal or Wise or whatever apps you're using daily, you notice.
You absolutely notice. And the sources use the term attrition. It's a polite way of saying customers start leaving.
They vote with their feet, or their thumbs, I guess.
Precisely. And there's data in the sources backing this up. One study found that 42% of consumers have actually considered getting financial services from companies other than traditional banks. They specifically mentioned tech companies. Think Apple, Google, social media platforms, even big retailers. Companies whose main business isn't banking at all.
Wow.
But they're seen as viable options, often because they nail that seamless digital experience, and payments are a big part of that.
42% is a huge potential vulnerability for banks. And it gets worse, right?
It does. The sources highlight the trend is even stronger with younger people. That 42% figure jumps to a massive 63% for consumers aged 18 to 34.
Almost two-thirds.
63% of 18 to 34-year-olds have considered getting financial services from a tech company or retailer instead of a bank.
That's not just a number. That's a massive red flag for the future of traditional banking.
It really is. Younger generations grew up digital. They expect banking to be as easy and instant as everything else they do online, ordering food, streaming movies, chatting with friends.
They don't have the same ingrained loyalty to the old bank on the corner if it doesn't deliver digitally.
Not really. Especially when it comes to something as basic as moving money. If banks can't meet those core expectations for speed and ease, they risk losing that entire generation as primary customers. The need to modernize, starting with payments, is incredibly urgent based on this data.
So the challenge is crystal clear. Adapt or risk losing significant ground, especially with future customers. And the sources really help us understand the deep down technical reasons why adapting is so hard for them. It's not just old hardware. It's the fundamental way they're structured to handle money.
Exactly. The sources talk about banks having to manage this complex web of payment rails.
Payment rails. Okay, we touched on that. Can you break that down a bit more? Why is managing this web so tough with old systems?
Sure. Think of payment rails as the different highways money can travel on. You've got the new super fast ones, the real-time payment networks like FedNow here in the US or the RTP network. They're built for instant money movement 24/7.
Okay, the speed demons.
Then you have the workhorse, ACH, that's mostly for batch processing, direct deposits, scheduled bill payments. It runs on a more traditional business day schedule.
Right.
Then there are wire transfers, often for large amounts, often business to business, sometimes international. They have their own set of rules and processes, often still quite manual in places.
Okay.
And of course, debit card networks for when you swipe or tap your card at a store.
Right.
Each of these rails, FedNow, RTP, ACH, Wire, debit, has its own technical standards, its own operating rules, data formats, security protocols.
And often its own dedicated system inside the bank.
That's the core legacy problem the sources point to. In the old model, banks often had separate isolated systems to manage each of these rails. The ACH system didn't easily connect to the wire system. This creates fragmented data. The bank might not easily see a complete picture of all your payment activity if it's happening across different rails handled by different systems. It forces manual steps to bridge the gaps. It increases costs, slows things down, makes consistent compliance harder, and ultimately creates that friction the customer feels.
Okay, so let's sum up the problem picture painted by the sources. You've got sky-high customer expectations for speed and ease, driven by digital life.
Right.
You've got traditional banks struggling with these tangled, siloed legacy systems that just weren't built for this. And you've got fierce competition from new players who are built for this and are setting the pace. It sounds like a perfect storm.
It really is. According to these sources, it creates this intense, urgent pressure on banks. The old way of doing things just isn't sustainable anymore.
Which leads us finally to the solution these sources are focused on: payment hubs. So how do these hubs supposedly cut through all that complexity and help banks actually compete?
Okay, so the basic definition the sources give is pretty straightforward. Payment hubs are unified platforms that consolidate all payment processing.
Consolidate. There's that word again. So bringing all those separate rail systems, ACH, wires, real-time, all under one digital roof.
That's the core idea. Instead of running 5 different old systems, you implement one modern central platform, the hub. It acts like an air traffic control tower for all payments.
I like that. A control tower for money movement.
Yeah. All payment instructions, regardless of type, come into the hub. The hub then intelligently figures out the best way to send it, manages the process across the necessary rails, tracks it, and provides a single source of data back to the bank systems.
Okay, so that central control is key. And the sources really emphasize how this directly improves the customer experience, right? They say hubs enable a fast, consistent, and straightforward payment experience regardless of rail.
That's the #1 customer-facing benefit highlighted. From your perspective as a customer, it shouldn't matter if your payment is technically going via ACH or RTP. The experience should feel the same: fast, reliable, transparent.
How do the hubs actually achieve that consistency?
The sources explain they act as these central platforms that are tightly integrated with the bank's main systems, customer records, account balances, etc. They basically absorb the complexity of dealing with all the different payment networks, whether the domestic rails or the international ones mentioned. They handle those connections and translate everything into a simplified, unified process for the bank's front-end channels, like the mobile app or online banking.
So the hub deals with the messy network details, and the customer just sees a smooth process.
Exactly. And a key part of this, stressed in the sources, is the intelligence built into the hub. They can automatically assess the available payment rails for any given transaction.
Ah, so they choose the best path.
Yes. Based on rules, the bank sets may be prioritizing speed for certain payment types or lowest cost for others. This smart routing happens instantly behind the scenes.
So it's not just putting everything in one place, it's making smart decisions automatically. And the customer benefits, speed, confirmation, transparency flow directly from that automation.
Absolutely. Faster transactions because the best rail is chosen automatically. Instant confirmations because the hub is designed for real-time communication. Transparency on timing and fees because the hub centralizes that information. All that complex back-end stuff is managed by the hub to deliver that simple, reliable experience the sources say customers now demand.
And this isn't just a theoretical future thing. You mentioned a statistic earlier.
Yes, the sources cite that 60%, 60 of banks have either already put a payment hub in place or are actively in the process of implementing one.
60%. So this is already a major trend. It's happening now.
Definitely. It shows that a majority of the industry sees this as a strategic necessity, not just an option. They're actively investing in this technology.
Okay, so it's real and widespread. And the sources suggest these hubs do more than just route payments efficiently. They're described as comprehensive platforms.
They are. The sources point out that the leading hubs manage the entire payment life cycle. Initiation, getting the instruction, processing, moving the money, reconciliation, making sure everything matches up, and settlement, the final posting to accounts.
The whole 9 yards.
Right. But crucially, the sources emphasize that the advanced hubs also integrate other vital functions directly into that flow, things like sophisticated fraud detection.
How does that work within the hub?
Often using real-time transaction monitoring, looking for unusual patterns, maybe using AI or machine learning. They also build in compliance tools, automating things like KYC, know your customer checks, or AML, anti-money laundering, screening as the payment is being processed.
Ah, so compliance isn't a separate later step.
Ideally, no. It's integrated. And they provide advanced analytics, giving banks much better visibility into payment trends and potential issues.
So the hub isn't just a faster pipe for money, it's also a smarter, more secure, and more compliant pipe.
That's a great way to put it. And the sources explain why integrating these things is so important. Automating fraud and compliance checks right there in the central hub doesn't just improve security and satisfy regulators more efficiently.
It makes things faster for the customer, too.
Exactly. It reduces the need for those annoying manual reviews or compliance-related delays that can happen when these checks are done in separate, older systems. Minimizing that manual intervention is key to delivering the speed and security needed today.
Speed, safety, and smarts all working together in one platform. And you mentioned the smart routing could also save money?
Yes, the sources point that out explicitly. That intelligent routing can mean cost savings for both the person sending the money and the person receiving it.
How so? Can you give an example from the sources?
Sure, they give a really practical one. Imagine a business needs to send out payroll urgently. The hub could be configured to automatically route those payments via a faster, real-time network like FedNow or RTP, ensuring employees get paid instantly, even if that costs a few cents more per transaction.
Okay, speed is paramount there.
Right. But then, maybe the same business has a routine payment going to a regular supplier where timing isn't critical. The hub could intelligently choose to send that payment via ACH, which is usually much cheaper per transaction.
Ah, so it optimizes based on the needs, sometimes speed, sometimes cost. That's genuinely smart, adding value beyond just efficiency.
It's about tailoring the payment method to the specific situation automatically. And to make this more concrete, one source actually mentions a specific product example, the FIS Money Movement Hub.
Okay, what did the source highlight about that particular hub?
It's presented as an example of a platform designed to tackle exactly the kind of payment friction we've been discussing. A key feature emphasized is its universal API application programming interface.
API. That's basically the standard way for different software systems to connect and exchange information, right?
Exactly. And the source notes that this universal API is a big deal because it allows a bank to connect to all the major payment networks, instant rails, wires, ACH, etc., through just one integration point with the hub.
So instead of the bank needing to build and maintain separate, complicated connections to each network individually,
Right.
they just connect once to the hub's API, and the hub handles talking to all the different networks behind the scenes.
Precisely. The source explained how this massively simplifies the technical burden for the bank. It turns a complex web of connections into what they call a uniformly smooth journey for customers on the front end because the hub hides all that underlying complexity.
That sounds like a huge win for the bank's IT department. Less complexity, probably lower costs, easier maintenance.
Absolutely. And the source also points out that this specific FIS hub example has built-in fraud controls, including real-time monitoring. Integrating security right into the flow like that means transactions are faster, more convenient, and more secure without the customer even necessarily noticing the security working in the background. It makes the whole concept much more tangible.
Okay, so the benefits for the customer are really clear. Faster, smoother, more consistent, transparent, secure payments. But the sources argue the benefits for the banks are just as significant.
Yes, they make that point very strongly, that hubs optimize things for the financial institution as much as they do for the customer.
As much as. That's bold. So how do banks benefit so profoundly internally?
The sources break it down. First, big gains in operational efficiency through automation. Consolidating all those separate, often manual processes onto one digital platform cuts down massively on human intervention, which means fewer errors and staff freed up for other tasks.
Makes sense.
Second, system consolidation lowers costs. Maintaining one modern hub platform is way cheaper and easier than nursing along multiple complex, aging legacy systems. This reduces what the sources call technical debt.
Right, that burden of old tech.
Exactly. And these automated workflows and the single platform mean less work for the bank's IT and payment teams. Instead of constantly patching old systems or manually moving data around,
They can focus on innovation.
they can focus on building new features, improving customer experiences, or other strategic work. The sources say hubs help banks break down silos, making the whole payment operation run more smoothly across the entire organization.
It really sounds like cleaning up a messy, tangled engine room, allowing everything to run more efficiently and freeing up the engineers to design better things.
That's a good analogy. It lets them operate much more effectively. But there's another benefit the sources stress, which is maybe even more critical today: adaptability and the ability to scale.
Yeah, in a fast-changing market, being adaptable is crucial.
It's survival. The sources highlight that modern hubs are typically built on modular platforms that integrate easily through APIs. We talked about APIs making connections easy. Modularity means the hub is constructed like Lego bricks. You can add new pieces, swap pieces out, or update specific functions more easily.
So how does that Lego-like structure help a bank adapt in practice?
The sources explain this is what allows banks to pivot quickly to adapt to market changes. A new payment network like FedNow comes along, or a new regulation is introduced. A bank with a modular hub can integrate that much faster. They might just need to add a new module or configure an existing API connection rather than undertaking a massive overhaul of multiple old systems.
So they become more nimble.
Much more nimble, more like those FinTechs. The sources also suggest this flexibility helps banks expand far beyond traditional banking, maybe offering new kinds of embedded finance or integrated services.
It changes their whole posture from defensive catch-up to potentially proactive innovation.
Yes. And related to scaling, the sources mention the pay-as-you-grow model that often comes with modern cloud-based hubs. Banks can add capacity or turn on new payment types as needed without the huge upfront investment previously required to build out dedicated infrastructure for every new thing.
That lowers the barrier to entry for offering new services, making innovation less risky financially.
Definitely. The sources directly link cloud tech and open APIs in hubs to cutting costs, scaling easily, and, importantly, launching new services faster, things like request-to-pay features or better cross-border payment options that might have been too complex or expensive before.
So it's not just fixing the past, it's enabling the future. Hubs provide the foundation for banks to actually create the next wave of financial services.
That's a really key theme in the sources. And the final major benefit area, they cover loops back to risk and cost. Enhanced security, better compliance, and avoiding some potentially massive financial losses.
We heard that 57% statistic about weekly business friction. How does that connect to actual dollar losses?
The sources quote a really eye-watering figure from surveys of business executives. Businesses are losing, on average, $98.5 million every single year due to problems and inefficiencies in how money moves.
Wait, nearly $100 million annually per business surveyed, on average. That's astronomical, just from payment problems.
It's a staggering number, and it puts the cost of inaction into sharp relief. The sources break down what those executives said were the main causes of these huge losses.
Oh, what are they?
Number one, cited by 88%, was cyber threats. Number two, 79% blamed fraud. And number three, 65% pointed to the difficulty of navigating complex regulations.
Okay, so security threats, criminal fraud, and regulatory burden are the big three drivers of these massive losses.
Those are the top three. Others mentioned were things like payment gridlock, cash flow issues from delays, shortages of tech talent to manage the complexity, and even reputational damage when payments fail. But the sources argue that payment hubs directly address those top drivers.
How do hubs help fight cyber threats, fraud, and regulatory complexity specifically?
By bringing everything together. Unifying those fragmented payment workflows onto one central digital platform gives banks what the sources call unrivaled visibility.
Unrivaled visibility. What does that actually mean for stopping fraud or ensuring compliance?
It means instead of trying to watch dozens of disconnected systems, potentially missing things that fall between the cracks, you have one place where all payment activity is monitored. This makes it much easier to spot suspicious patterns in real time, apply fraud detection rules consistently, and enforce compliance policies across every single transaction, regardless of the payment rail.
So the consolidation itself makes monitoring and control far more effective than trying to bolt security onto separate older systems.
Exactly. It provides a single powerful vantage point. You can apply sophisticated tools more effectively. You have a unified audit trail. It directly strengthens the bank's defenses against fraud and makes proving compliance much easier.
So the hub becomes a central shield, in a way.
That's right. The sources say this unified approach delivers that unrivaled visibility, compliance, and fraud resistance, leading to smarter money movement.
Yeah.
And that smarter, more secure movement is what protects businesses from those huge potential losses and keeps the bank itself safe and agile. It's a fundamental risk management improvement over legacy setups.
So hubs aren't just about customer happiness or internal efficiency. They're critical for protecting the bank and its clients from very real, very large financial dangers. That's a compelling case for adoption all on its own.
It really addresses the major pain points that those surveyed executives highlighted.
Okay, let's try to weave all this together then. What's the big picture the sources are painting about payment hubs?
Stepping back, the sources clearly establish the situation. Customers demand seamless, instant, transparent payments, largely because digital competitors have set that expectation.
Right.
Traditional banks, held back by complex legacy systems, struggle to deliver this consistently, which risks losing customers, especially the younger generation.
And the payment hub emerges as the strategic fix. It's the unified, intelligent platform that lets banks finally provide those modern experiences, helping them keep customers and compete head-on with the digital natives.
But it's not just about the customer experience, as crucial as that is. The sources strongly argue that hubs bring equally important operational and financial wins directly to the banks.
Yeah, that dual impact seems key. We saw the efficiency gains from consolidation and automation, the better transparency and compliance, the reduced IT burden, the newfound adaptability to market shifts, lower costs, easier scaling.
It's a long list, and there's a quote in one of the sources from Elaine Duff at FIS that really captures this transformative idea. She says, "The Money Movement Hub is more than a platform, it's a launch pad for transformation."
The launch pad for transformation. I like that. It's not just fixing something broken, it's enabling something new. Does the source elaborate on that launch pad idea?
It does. She explains it's about taking those messy, fragmented payment flows and turning them into a unified, intelligent ecosystem. And this ecosystem helps banks reduce friction, accelerate innovation, and move money with purpose.
Move money with purpose. Interesting phrase.
Yeah. And the source wraps up her point by calling the hub the infrastructure behind the next generation of money in motion.
Wow. The infrastructure behind the next generation of money in motion. That really frames it differently, doesn't it? It's not just about processing today's ACH and wires better. It's about building the foundational roads and rails for whatever comes next in finance.
Exactly. It suggests that having this kind of modern, flexible, API-driven hub isn't just an upgrade. It's becoming essential infrastructure for any bank that wants to innovate, integrate with fintech partners, and offer the kinds of services customers will expect in the future.
It really does feel like a defining moment for traditional banks. Make the investment to build this modern foundation, or risk getting left behind as money continues to move in faster, smarter ways.
That's the strong implication. The ultimate takeaway from these sources seems clear. Payment hubs are becoming critical for banks to satisfy today's customers, streamline their own operations, manage risk effectively, and crucially, position themselves to adapt, innovate, and thrive in the rapidly evolving world of digital money.
Okay, and that wraps up our deep dive for today. We've gone from the core problem banks face, that clash between soaring customer expectations and creaking legacy tech, right through to the payment hub solution and its benefits, which, as we saw, are huge for both customers and the banks themselves.
Yeah, we hit on some key data points: that weekly payment friction for businesses, the startling number of younger consumers open to non-bank providers, those massive potential annual losses from inefficiency and fraud, and the fact that 60% of banks are already making the shift.
So as you go about your day, maybe paying for coffee with your phone or checking your balance, just think about the complex machinery working behind the scenes that these sources shed light on. That seamless tap-and-go experience relies on increasingly sophisticated infrastructure, and traditional banks are racing to upgrade theirs with these payment hubs.
And maybe one final thought to chew on, based on that launchpad idea. If payment hubs really are the infrastructure for the next generation of money in motion, what happens next? As more banks get this foundation in place, how might the whole financial landscape shift? What completely new ways of using or moving money might become possible that we haven't even thought of yet?
Something to ponder. Thanks for joining us for this deep dive.